Howdy, folks. This is episode 3 in our series on planning for high earning individuals or families. I hope this finds you well. If you have feedback for us, please let us know. And I hope this is useful. We're going to talk about a little math today. I'm not going to show you a bunch of math. We have software for that. But it is important, and most people, I think, don't spend enough time on this, to understand what your savings capacity is and then what your savings plan ought to be in order to achieve whatever your desired outcome is. So in this case, we're going to talk about a family earning $300,000 a year or an individual. We're going to ignore the effects of inflation, and we can go into detail why. And some people argue that you can't. And okay, but we have software to do this. We're going to ignore the effects of taxation. We're just trying to get to a baseline. For the most part, we're going to ignore the effects of taxation, investment taxation, earnings taxation. We're not going to ignore the effects of. And then I'm going to assume that it's two people that are making maximum contributions to 401k plans. So call them two people making 150 apiece, one making 200, one 100, doesn't matter. But foundationally, $300,000 income, $45,000 a year to 401k plans. Again, none of this inflation adjusted. Pre-tax earnings, $255. Let's assume a marginal tax rate of 25%. There are higher tax states like California and New York, and I know that, but for modeling purposes, that net income after tax and after contributions to 401k plans, $190,000. I'm going to assume you save $35,000 a year outside of your 401k plans, and that makes your spending $156K, $13,000 a month. If we set aside $3,500 a month for housing costs, then you've got about $9,500 a month to spend. My experience working with clients across the country is that's a reasonable amount. Of course, you can spend more, you can spend less. We can have lots of planning conversations about why you might do that and why you wouldn't. Let's compound that money for 25 years. So maybe you start at 30 and end at 55. Maybe you start at 40 and end at 65. And let's use a 6% net rate of return, net of investing expenses, net of any advisory fees you might pay, 6%. What's your outcome of that? Well, it's about $4.8 million saved. If you convert that into income, you'd get a range of somewhere between $160,000 a year and $220,000 a year, depending on assumptions and how you design the income stream. That's ignoring Social Security. So this is no raises, no inflation, everything leveled out. My point of doing this is if you take a plan like this, you basically equalize your income when you stop working with the after-tax spending that you have while you are working. That's not an insignificant sum to save. It can be done. It takes discipline. Very few people do this without some level of discipline and doing what I call putting a jar around the gas to contain the expansion of the gas. Because my other experience is everybody's spending expands with income. That's just normal human behavior in our society. I hope this is interesting and finds you well. I'd love to hear your feedback.